been the week of whiplash, can't say the word, when it comes to U.S. Treasuries, and really a focus on rates, too, around the globe. We've got a great roundtable. Ira Jersey, Bloomberg Intelligence, Chief U.S. Interest Rate Strategist, and Sarah Hunt, Chief Market Strategist at Alpine Saxon Woods, both here in studio. Traders are increasingly questioning what Treasury Secretary's next move will be after what's been, I think it's safe to say, a bit of a turbulent market, bond market this past week. Sarah, how do you see it?
I think that it was a surprise that he came out and said, this is what we're going to do in the long end of the curve. I think everyone's been looking at Warsh, Chairman Warsh, and looking at the Fed and seeing what's going to happen with interest rates there. I don't think that people were expecting the Treasury Secretary to come out and make his own news on this particular front. And I think there are, as you can see, quite a lot of questions about, one, how this is actually going to work mechanically, two, whether or not this is going to actually help the long end of the curve, which was arguably the idea, because you've round-tripped that already.
Because it did and didn't.
It did and it didn't. And on the other hand, gold is just like, okay, we're gone.
Yeah.
And it just is going again today. And I think that that's, whether or not the only signal that gold gives is that we don't like anybody else's decisions, or it's just a way to play a different angle, I think that you're seeing that reverse in interest rates didn't reverse gold. So that may be an anticipation of further movement.
Gold up 5% this week. So yeah, we've seen a big move.
I mean, Ira, where do you stand on this? Now that this is Friday, it's been a couple days. Yields are still moving up.
Yeah, well, yields are kind of flattish, right, from the beginning of the week. So, yeah, it did a whole lot of nothing. Devil is in the details here a little bit. So, we won't find out the exact size. He says maybe next week that they'll tell us more information. I did think it was really funny when Scott Bessent said, we're doing this because there's, low liquidity in the middle of summer and things like that. But this doesn't start till September 9th. So I'm not exactly sure.
That's technically the summer, right?
I guess, but it's not August. It's not now.
Yeah,
right?
not the summer.
And in fairness, I was looking at the depth of the market actually right around the time that he said that. And actually the depth of the market was not bad, right? The depth of the market was your typical summerish levels, not insanely low. So it's not like they really needed the direct liquidity support here.
That's what I was going to say. Political, or did the market need this, Sarah?
So it's interesting. I think that people have been concerned globally about rates rising, especially on the long end. And that's been a problem for investors. It's been a problem for all of these companies that are now trying to finance the entire AI build out.
Government.
So the question is, are we doing something because this exact amount of money is going to make a change? Or is the fact that we're saying we're going to do something reminding everyone that the government can come in at any time and change the game? And I think it's a little bit, to me, of that. I don't know how you feel about that, Ira, but that was, my take was a little bit like, we're going to do something and not just stand there and let the market figure it out.
Yeah, I think they did this, and it was kind of underwhelming, right? It's kind of like the Federal Reserve in December of 2007 when they did a $40 billion program for a $300 billion problem, and it's something like that. Maybe there will be a little bit more shock and awe, but there are risks to what they're doing too, right? Like if they're going to issue a whole lot of T-bills in order to buy back a lot of debt, and let's call this what it is.
Yeah.
If it's going to work, and if the president and Treasury Secretary are really serious about getting long end yields down, they have to do this in size. And we have to then call this an Operation Twist, similar to what the Treasury Department did in the 1960s. And if they do that, the one big risk for them is what happens if the Federal Reserve has to raise interest rates, because they're going to be issuing T-bills, which capture that interest rate move almost immediately, compared to 30-year debt, which obviously takes 30 years to recapture that new interest rate environment.
Sarah, what do you think it means for the Fed? Does this at all kind of alter when we do get a move from the Fed?
I'm not sure what the answer to that is, and I don't know if there's any actual coordination going on that we don't know about. I mean, what we see is what the headlines are. We don't see what everybody's talking about behind the closed doors. So whether or not there is a conversation, I couldn't tell you. One would hope that there might be some sort of coordination, or at least an understanding, because otherwise then you start to look like you've got government departments fighting one another. So what's your take on that?
Well, I think that they're not coordinating, because if they were coordinating, then the Federal Reserve would not have stopped buying T-bills.
Yeah.
The Federal Reserve was doing these reserve management purchases, buying $10 billion of T-bills every single month. So if they were coordinating, and Treasury Secretary Bessent said to Kevin Warsh, hey, we're going to be issuing more T-bills to buy 30-year debt, how about you buy some of those T-bills? Well, the Fed's not buying those T-bills. So if there was coordination, it was pretty poor.
Is this President Trump potentially too saying, hey, Scott Bessent, I need you to do something because my Fed chair isn't doing something? Is it possibly?
Absolutely possible, right? Because again, I think we're all trying to understand, struggling to understand exactly what the point is, in the timing frames.
So fast forward. Okay. So do we get answers at Jackson Hole this coming week? I mean, we have a Fed chair who has already shown he doesn't like to say a lot or lay out the metrics of what metrics he is following and the Fed is following, the FOMC, in terms of figuring out monetary policy. Do you think we're going to get anything this week?
Well,
More
he's told us he's going to frame the big questions, and
you can lay them out, but if you don't say what you're following,
well,
right?
and this is the challenge that Kevin Warsh really has had, and I don't think he's done a particularly good job in communicating with the markets, because you have to give the markets something, right? You can't give them nothing, and he's basically given the markets nothing. So he has to either give some kind of forward guidance, or say, if this happens, then we will react this way. So give a reaction function. You have to do one of those two things. It's interesting because he put Mervyn King, former Bank of England governor, on the communications task force. This is what Mervyn King wants to do. He says that, hey, we want to give the reaction function. We don't want to give forward guidance. But Kevin Warsh clearly has, if he read that paper, then he's not following it for sure.
Well, and I also think that you're at the point now where you have to really look at that speech. If it was going to be under a microscope, now it's under 5, right? Because now you went from we're all
every LLM is going to get that speech, and we're going to get analysis.
And everybody was focused on the Fed, and then they turned to the Treasury. So now the Fed's now they're extra focused on what they're going to say. And the fact that the communication has been, I would say, uneven is a word that you could use, doesn't help the situation. And I think that it makes it more important to clarify whatever. So I think Jackson Hole is, we're all going to be sitting around on Friday watching what's going on.
And we'll probably all fall asleep because it won't be very interesting.
But we're going to have to watch it anyway.
In the background, relaxing.
Well, we're all going to be waiting for the walk, right? We're going to be waiting for all the central bankers.
Tom, Mike, and Lisa are going to be there. It's going to be interesting. Sarah, layer on top of this, and we've already talked with Ira about this, about the data center build-out. And you write in your notes, the pushback against data center build-out could be a blessing in disguise, as well as investor concern over CapEx spending has been growing as the hyperscalers commit ever more equity and debt to the build-out. We've been talking about how the hyperscalers and everybody AI-related tapping credit markets and what that's done to maybe crowding out the Treasury trade. How worried are you about all of this tapping of the credit market for these AI guys?
I think that there was definitely concern about how much money was being raised, how fast, and at the same time, you've got the government racing into raising. I mean, everyone's raising money, right? So that was an issue. Whether or not this money is actually going to have a return on investment is another question that people have been going crazy about. The idea that it's an arms race, that you have to spend faster than China. The fact that there may be a bottleneck could be a blessing in disguise, just in the fact that people are worried so much about that spend and how much of that spend is coming out of debt and equity and no longer cash flow. And if that slows down, maybe that gives investors some room. Whether or not that becomes a further race to the top between China. I mean, I'm not sure how to look at that CapEx relative to other things, and I think that investors are struggling with that.
Hey, join the crowd. I don't know how to look at it either. Like, I feel like increasingly we say this, we see the headlines, we see the spend, and we're trying to put it in context.
I also want to ask you about where equities go from here, especially if rates stay high.
Yeah, equities.
Because, we haven't really seen, I mean, even this week, it hasn't been carnage in the S&P 500. But the 30-year yield is, it's at these highs. Does this continue, or is there really going to be some movement?
Well, I sort of think that this is where Treasury came in and did something to the long end, because that was starting to get investors worried. And you were seeing the S&P start to degrade, and the indices and other stocks underneath it as well. It's really going to be, it's a combination of, it's going to be about earnings. And somebody made the point this morning, and I can't remember who it was. They were saying, earnings are great, but people are outspending those earnings. And that's a really good point, because as we get into 2027, are we going to continue to up the ante on spend? And are the earnings going to follow? And I think that that's really, earnings is the biggest problem or benefit to the S&P. And right now, that's all been working in everybody's favor. If that starts to trip and that second derivative starts to go, it doesn't even have to go down, it just has to grow less fast. And that becomes an issue unto itself, given where valuations are.
Can we just keep going? This was really great. Come back next Friday?
Sure, I'll be in Princeton.
You'll be on vacation.
You'll be on vacation. All right, maybe a couple weeks from now. Ira Jersey, thank you so much. Bloomberg Intelligence Chief U.S. Interest Rate Strategist, and Sarah Hunt, Chief Market Strategist at Alpine Saxon Woods. Just a reminder, we did have a headline, U.S. Chief Justice John Roberts saying President Trump can keep building his new White House ballroom for now, while the Supreme Court